Hello and welcome back to another episode of the Investor Financing Podcast. And on today's episode, we're going to discuss DSCR loans and what's going on with the market. Today and the last month and a half or so, obviously everybody's seeing rates are going up and the DSCR loans have gone up a lot. They were in the low to mid fours about a month and a half ago, 2 months ago, and now you're seeing 6 and 7% on these DSCR loans. So what can you do now with these type of loans? Because a lot of these loans are great loans, right? Like no tax returns required. It's just based on the cash flow and the credit score of the borrower. It's a perfect investor loan. So what I'm helping a lot of my clients do is instead of going into the 30-year fixed, we're looking at a 7-year fixed IO, or which is interest only, right? Or potentially just an amortized 7-year fixed loan. And let's face it, the average real estate investor is going to be harvesting equity or selling properties every 4 to 6 years, most likely. So a 7-year fix seems to be the best product right now, pricing wise. If you look at the 5-year and 7-year, their pricing is very comparable. So you might as well go with the 7-year versus the 30-year. And I like the IO right now. I just think that it makes sense in this market to go interest only. And you know, every deal is different. But for me, I want to cash flow as much as possible today versus down the road. And, you know, what am I going to pay down over the next 7 years? I have to take that into account. Does it make sense to do some principal pay down, or isn't interest only the best option?
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, Beau here, and I want to thank you for being a patron of this YouTube channel, or if you're listening on iTunes, Stitcher, or any of those audio platforms, I want to give you my book for free that I just wrote. It's called Launch, Expand, or Buy Your Next Business Using SBA Financing. And you can simply go to thesbabook.com and you can receive a free copy of my book. That's thesbabook.com. And thanks so much for being a valuable listener or viewer of the show. And I hope you enjoy the book. It's a very short book. It goes into detail. You can read it very quickly and get a good overview of all the benefits of using SBA financing. So thanks so much, and I'll see you soon. So that's really the update right now. I think rates will continue to increase over the next few months, and so we're just in a new world, and the it is what it is, right? And we got to make the best of it. Now, I've talked to about this in previous episodes. Another option is you can do a long-term bridge loan or a longer-term bridge loan. Instead of 12 months, you could do a 24, potentially a 36-month bridge loan. So some of the properties that I'm acquiring that need a little TLC, I'm going that route. So I might be borrowing 85% of the purchase, potentially 90% of the purchase, and 100% of the CapEx or rehab. And then I purposely do that loan for 24 months. You can, with some of these bridge lenders, they'll allow you to do 12 or 24 months. Some of them even do 36 months. But that gives me a time to make the repairs, lease up the property, whether it's a long-term or short-term rental property, get the payments coming in, and then refinance 12, 24 months later, or potentially sooner, depending on where we're at with the deal. And really, if you look at an amortized payment at, say, 5% versus an interest-only payment at, say, 6 or 6.25%, what's that difference on payment? It's not that substantial unless it's a really big loan amount, depending on what price point you're buying these type of properties. But that's just another strategy to look at the market now and then figure out what really makes the most sense. Obviously, there's still credit union money out there with their commercial division, so sometimes that's an option. But once again, they're looking at your global cash flow, they're looking at tax returns, they're looking at all that. So the DSCR loans are still really like the cream of the crop. Now, when we're talking about the other kind of topic I want to give an update on is when you're looking at a property that's a short-term rental, that's going to be a short-term rental, and your gross revenue is going to be projected at X, right? and you have no problem from a debt service coverage ratio standpoint, that's great. Now, the other question I always ask is, if that were to be a long-term rental, what would the monthly rent be? And sometimes you can get these projects funded with these based on the rental survey that's done, and that qualifies you based on long-term rental income. Now, if it's just way off, then your only option is to utilize a lender that does purely projection-based DSCR loans, right? And there's like 3 lenders out there that I work with that specifically do projection-based loans when you can't qualify from a long-term rental standpoint. So this is the conversation I have with all my investors right now. Like, I just ask very simple questions, and then we can figure out, does it make sense just to go to a projection-based lender, or can we use a LTR, long-term DSCR lender? And if you go to strlending.com, you can see I just asked those questions. That's exactly what any of us in the industry need to know to basically give you the best advice on what options would make the most sense for what you're trying to do. All right, enough of me rambling on. I hope you enjoyed this episode of the Investor Financing Podcast, and I'll see you on the next episode.